Good morning, everyone. Thank you so much for joining us today. Well, the US and Iran have reached an agreement to reopen the Strait of Hormuz and extend their 60-day ceasefire. Oil prices are down, equities are up, and there's growing optimism that the global economy can avoid some of the worst case scenarios, some of the worst case outcomes. But have markets got ahead of themselves a little bit, or is it all plain sailing from here? Our analysts are here to answer some of those questions and more. Joining me in the studio is Chris Turner, who's our global head of markets, and Mikhail Tucker, who is our senior rate strategist. And then joining us from Frankfurt is Carsten Bresky, who is our global head of macro. I'm Rebecca Byrne. If you have a question, there's questions tab. Please feel free to put them in there and we'll get to them a little bit later on. But let's go straight to a poll. As you know, oil prices have fallen below $80 a barrel now, which is sort of where they were at the beginning of the Iran war. But where do you think they'll go, or where do you think they'll be headed by the end of 2026? These are your options. Put your answers in and we'll come back to them in just a minute. But let's go to Carsten now. Carsten, I know that Warren, our resident oil guru, is sunning himself on a beach somewhere, but I know you've been in close contact with him. And can you tell us what the ING's oil scenarios are now?
Yeah, I think for everyone listening, you need to get hold of Warren's vacation plans for the next month and years, because there is a strong correlation with everything going on in oil markets. But it's a secret when he will be off next time. I think for us the market reaction was a bit too good to be true. Because it indeed felt on Monday and also yesterday a bit like as if things were only going better now. We're not making this a geopolitical webinar about all the things that still could go wrong in the negotiations. We will not talk about whether actually President Trump achieved what he had announced he wanted to achieve when he started to attack Iran. But it's about oil, and you just have to imagine it takes a while to really reopen the strait. It takes a while to get rid of all the mines if they are in the straits. It takes a while to find insurers and to determine what the insurance premiums are for the vessels passing the Strait of Hormuz. So this is why we think markets were a bit carried away by themselves. Going to take a while before you really get a full functioning and reopening of the Strait of Hormuz. According to Warren, this it will take really until the end of the year, until we are back at the flows, the traffic that we had pre-war, which then also means we still see oil prices only at $85 per barrel by year end, and then throughout 27 also continuing to decline further, so that by the end of 2027 we're slightly above $70 per barrel, which then would bring us more or less to the levels we had seen at the start of this year.
Okay, do we have the results of that poll? It would be quite interesting to see where you think oil prices. So you think between sort of $70 and $80. So possibly some more decline from here, according to the market. But and of course, Trump has said the strait is totally open, let the oil flow. But you're saying it's going to take a while longer. But how has this shifted the outlook for growth and inflation? Does it actually change the trajectory at all? Sounds like maybe not so much, but maybe the inflation genie is out of the bottle already.
Yeah, exactly. That's it, Rebecca. So we are already facing this first wave of inflation, and that cannot be stopped by whatever deal. And this first wave of inflation means that we will see not only energy price inflation, we will also see these knock-on effects on transportation, on food prices, and what have you. So this is an inflation wave that is already in the making and will continue. So we still expect for Europe, but also for the US, that headline inflation will continue to increase a little bit. In the case of the Eurozone, we see it then peaking somewhere close to around 4%, and then towards the end of the year in 2027 coming down rather quickly. We had, I think, the advantage, we only released our latest monthly update last week, and apparently we had so much foresight that we included a milder version to our scenario scenario. Our base case scenario last week was that it would take now until end of July before there was a resolution coming in the Middle East. But this is coming earlier. But we had already prepared this milder scenario, which then indeed means it's more about what will happen to inflation in 2027, what will happen to growth in 2027, and there obviously now the adverse effects from the energy price shock with a slightly lower energy prices will be lower, but it is not making a hell of a difference.
Okay, we've got the Fed meeting later today. What do you think Warsh is likely to say as a result of all this?
Yeah, that's obviously a very, very exciting one. And our resident Fed watcher, James Knightley, well, wanted to have a bit of a sleep this morning. So that's also why he's not joining us. It's very exciting because Kevin Warsh, of course, who is, well, first meeting with Kevin Warsh as at the Fed. Everyone expected him to push actually for rate cuts. Very tricky to do, given that also headline inflation in the US has clearly accelerated. Also, markets and some Fed officials are rather now tilting towards a tightening of monetary policy. So I would expect, or we do expect, Wars to keep a more balanced approach at the meeting. Maybe give it a slight hawkish tilt. So kind of signaling that if things were to escalate in terms of inflation, that the Fed also stands ready to act. But further down the road, we still continue to expect that there will rather be rate cuts than rate hikes. Not this year, but in 2027. And then people ask, well, why do you expect rate cuts? Well, first of all, the policy rate of the Fed is still slightly restrictive, so there is a bit of room for the Fed to cut rates and then bring them into neutral territory. And the other reason is that we still expect the labor market to weaken a little bit. There are also signs that the real estate market could cool off further. So I think further down the line there are good reasons to believe that Kevin Warsh will actually do what everyone expected him to do, namely cut interest rates, not today, but in early 2027.
Okay, good to know. I want to know what you think about the ECB as well. But first, we've got another poll for you. Over the next 12 months, the ECB will do what? Remember, it hiked interest rates just last week to 2.25%. And there are signs that, maybe it'll do a bit more. But do you think they'll cut or hike again? What do you think? Put your answers in. And again, we'll come back to them in just a minute. But Carsten, what does this deal mean for the ECB? Does it take the pressure off them to hike again?
Oh, at least for further headaches for the ECB, obviously speaking, and it could bring across this idea that maybe last week what was a mistake, and that they jumped the gun. I think in our view, we still see the ECB hiking a second time. And I think that also has to do with the psyche of the ECB. It would namely then really show to the markets that they were fully convinced that the June hike was justified and that they would deliver a second rate hike also, as the inflation wave is currently unfolding. So even though Christine Lagarde didn't like the term insurance rate hike, as she stated last week, a second rate hike would still fall under this category of in insurance rate hike, a rate hike under risk management aspects, because it would then still be a rate hike that will have lower potential cost to the reputation of the ECB than it would have to inflation. So I think that's why we still see a rate hike either in July or September. But obviously speaking, if we're wrong with our energy price forecast, if energy prices were to drop much faster, that would also take away the pressure from the ECB to go for a second rate hike. The irony of history is actually that it happens hardly ever that the ECB leads the Fed with starting a new rate cycle. Well, now we have the ECB at the start of a potential rate hike cycle, leading the Fed. And the biggest irony would be if the ECB actually had corrected what it did last week, and if it turned out that the ECB was pretty wrong in jumping the gun.
Okay, we just saw those poll results coming up on the screen where 40% think that the ECB will hold at 2.25%, and almost as many think that the bank will hike once more to 2.5%. We're going to turn the focus to markets, and Mikhail is here to talk about bonds in particular. Mikhail, the euro swap rate and the 10-year bond are basically trading close to 3% despite this deal. Is there scope for rates to come down from here?
I think the short answer, not too much scope to come down from here. And I think there are three reasons. First of all, a bit like Carsten also mentioned, the damage has been done. And looking at those poll results, there's still a very strong conviction also in markets that there will be another ECB hike. Markets are even more tilted towards a third hike than just keeping it at 2. So it really shows the bias is still for the more hawkish side of things. So that keeps rates a bit elevated, and a lot will boil down to how inflation is going to develop from here. Another reason why I see rates still staying quite elevated is all the focus is on inflation, and together with quite a resilient growth picture. So markets are not too worried about growth deteriorating, even though we've seen some downside surprises in the data. Some PMIs have weakened significantly in the Eurozone. Markets really choose to focus more on the positive narratives. Manufacturing still doing well here and there, and that despite higher energy costs. And I think one reason why that optimism perhaps for markets is coming in is really market sentiment from the US being extremely positive. We see record high US equities. We have a rocket IPO breaching all records as well. And that's pushing up US rates too, which you can see spill over to euro rates. So what does it then take to really bring yields lower? Well, first of all, we need to have a clearer view on inflation. Is inflation indeed of the more transitory nature, with the word which we, of course, don't want to use? Will growth hold up? If not, then we could also see a bit of a downside surprise in rates there, and sentiment. I mean, I'm not going to make any calls about US equities, not an equity analyst, but of course, there are a lot of risk scenarios out there that incredible bull run sees an end at some point.
When you look at the market's expectations for inflation, there seems to be, yes, some inflation built in near term, but longer term, the inflation indicators have actually come back to where they were pre-war. How can we interpret these dynamics?
Yeah, let me start with the near-term inflation expectations. And I think especially in the Eurozone, you can see they're very strongly correlated to oil prices. So where inflation is expected to be for markets in 2027, you can see really goes up and down with oil prices on a daily basis. But there's also a bit of a drift in there, an upward drift. So the longer we are facing higher oil prices, even though they've come down a little bit, the more markets do see a risk of inflation staying a bit more stubborn in 2027. And you can still see markets are still positioned for well above 2% inflation for 2027. So that's really the near-term story, which is still very oil contingent. But if we look at long-term inflation expectations, there's actually still quite a comforting picture. In the Eurozone, yes, they've jumped up, but I think that's more of a normalization. Before they were below 2%, so that was really markets flagging more of a secular stagnation fear, that the ECB would really undershoot its target over the long term, and that we see has been pushing up above 2% again, but still 2.1%, which is very healthy. That means inflation expectations are very anchored. In the US as well, we see that inflation expectations rose a bit initially, 10-year inflation expectations, but now, as you mentioned, come back to pre-war levels. And this is a very important signal from market regarding central bank expectations. Markets are basically saying, we expect the ECB, the Fed, to do the right thing when it comes to fighting inflation. And over the long term, the inflation target of 2% is reliable. So that's actually a very positive sign that we see that very well anchored. And of course, that does raise the question, can that become unanchored? Can we see a situation where inflation expectations rise? And that would really be related if the ECB or the Fed does not act on inflation. But I think from what we've heard also during last meeting, it seems very much the ECB is willing to do whatever it takes to avoid it becoming too entrenched inflation, and we're going to see in the Fed today as well. So it's going to be interesting. The Fed, of course, we know Warsh is a bit more on the dovish side, but we doubt he will want to risk coming across too dovish, because then what you get is these long-term inflation expectations could rise a bit, and in fact you actually push up longer dated rates.
When you look at the 10-year yield, it fell a little bit on the deal, on the announcements, but real yields are actually up, what, about 40 basis points or something since before the conflict. How should we interpret that? Does it suggest that markets think policy could remain restrictive even as inflation expectations come down?
Yeah, a very good point about the real rates, because we really have to look at the current dynamics separate real rates from inflation expectations. And real rates have really been the big surprising factor. I think inflation component very well predictable using oil prices. In the US, we've seen real rates rise quite significantly throughout this crisis. And it boils down to a lot of resilient economic data. We see payroll numbers not cooling as fast as the market had feared. And on top of that, we have that market optimism coming from AI doing better than expected. Again, this IPO hitting new records. So that positive growth narrative really seems to be feeding into higher real rates. So the idea that over the long term, the US is able to grow at a higher pace than expected. There's also a bit of a Fed reaction function perhaps as well, sort of the idea that the Fed might have to hike a bit more to combat inflation, and that's also what's translating in higher real rates, especially at the short end of the curve, sort of 2-year real rates. But there's also a more structural factor, which I think we shouldn't forget when we're really focused on oil on a day-to-day basis or equities. There is the enormous structural deficit in the US as well. And that's a slower moving force, but that is also pushing up, especially longer real rates, 10-year real rates over time. So also when we look at real rates, we struggle finding scenarios that could come lower in the near term. Of course, comes down to, will growth be able to hold, or do we indeed see some signs of growth weakening towards the end of this year or perhaps even next year, because that would be indeed a driver to push rates a bit lower again.
Okay, thanks, Mikhail. So we talked a little bit there about equities and this incredible rally, as well as the bond market as well. But we want to know from you, which asset class will be the best performer for the remainder of 2026? Will it be equities, bonds, commodities, or cash? I think the Dow and Stock 600 hit records yesterday. So is that going to continue, or what do you think? We'll come back to that in a minute. But we're going to go to Chris now. Now, Chris, for a look more at the FX market, really. Now, you'd normally expect the drop in oil prices to weigh on the dollar because oil is priced in dollars. And, if oil's coming down, that hits inflation. Maybe that makes there's less scope for rate hikes or easier monetary policy. But we haven't seen that. So what's going on?
I think it really comes down to what Mikhail has just mentioned, the jump in US real interest rates. I mean, the difference is that actually the market, it's a little bit uncertain whether the Fed will pull the trigger on kind of rate hikes later this year. You remember, like the dollar bear trend at the start of the year, before the war, it was all about the Fed bringing rates down from 375 to 325, a sort of move to kind of neutral, very benign environment, kind of pro-growth. But there's this residual concern now that the Fed might have to tighten. And I think until the market can really dispel those fears of a Fed tightening, the dollar may not sort of quickly hand back all of those kind of gains, particularly seen over the last, I think, 4 or 5 weeks. Just as Mikhail said, the US data is coming slightly better than expected, making a Fed tightening cycle more credible.
Okay, now we did speak just last week about the euro dollar. And you mentioned then that 120 looked unlikely by year end. Is that still your view?
Less strongly held than last week. I mean, energy prices have come down very quickly, and obviously, what that means then is probably inflation will come down a little bit more quickly as well. The loss, in terms of like the hit to growth, as Carsten mentioned, maybe kind of a little bit kind of less than expected. But, at the start of the year, I think we and other banks were looking for something like 120 to 122 for like euro dollar at the end of the year. And that relied on that 50 basis points of like Fed easing. Since then, I mean, even here at ING, we're not looking for that easing cycle anymore this year. It probably does come into next summer. That's kind of ING's call now. So I think the idea of a dollar bear trend, I think, is probably going to be delayed, and I think there'll probably more evidence perhaps beginning at the end of the year, but I think not during kind of the second half. It's probably too early for that. I think we need to explore what has the hit been to European and like Asian activity, with obviously high energy prices, US obviously benefiting from the energy independence story. And I think the market will have to wait to see how the activity story plays out, how quickly inflation can come lower, how quickly the Fed can have the confidence to look through the inflation cycle, just like the Bank of Canada and perhaps like the Bank of England as well. But they're not there yet. So not guaranteed, but probably slightly more likely than last week.
Okay. Keep your questions coming in. We have got some, but remember that we're happy to comment on the impact on the market, but we're not going to speculate about the terms of this deal or the MOU or anything like that. But keep them coming in. We will get some at the end, but we have another poll, and it is which asset class will be the best performer of 2026, and equities, bonds, commodities, or cash. It looks like 58% think that equities will be the best performer of 2026. They're clearly pricing in a benign outlook. As I mentioned, Dow and stocks are hitting record highs. Have markets got ahead of themselves? I mean, what happens if this 60-day window fails?
Well, I suppose equities are seen as the inflation hedge, which is one thing. And at the moment, despite obviously the huge kind of surge in kind of US equities in the tech area in particular, the earnings story is still holding up basically. So it's not completely on kind of fumes kind of up here. But obviously if oil spikes again, or as Michiel said, some, left field risk of the long end of the bond market, coming off hard if Fed's wash sounds too dovish, too early, that could really upset equities. What do you think, Michiel, in terms of what could upset equity markets?
Yeah, I think that general upside potential risk for US Treasury yields is looming there. And it's not a new risk that we're facing. We've seen US Treasury yields go towards 5% earlier. We've seen that really triggering a bit of a panic in markets. And like I mentioned, there are plenty of structural factors which are adding up to these 10-year US Treasury yields. So I think that's a very valid, once you get 5% return on a US Treasury yield, would you then rather still be in equities, or is it time to switch?
Yeah, and I think I was interested in those kind of poll results because people are still very committed to equities. If there was a point whereby the higher energy prices took their toll on activity, started to impact kind of corporate earnings, and we saw that in the hard data coming through, I suppose the long end of the bond market would start to see, some kind of appetite coming through, right, for the downturn in activity and potential kind of rate cuts into 27 or so. But the market's clearly not there yet, right, with the bond story.
Okay. All right, good. We've got some questions coming in. So we're going to go to, I think, Carsten for this one. What would be the catalyst for the ECB to cut rates next year?
Just unmute here. Obviously, growth would be one. So disappointing growth figures. Which is possible. It's also when you look at what the ECB released last week with their macro projections or forecasts, still look pretty benign on the adverse effect of higher energy prices on growth. So I think a negative surprise on growth could clearly happen. And the other one is if in the end this big, don't mention the word, transitory would pop up again. Well, it is the Voldemort of Frankfurt of the Eurotower. Don't mention the word transitory. But if, and that's also interesting, in the ECB's own mildest scenario, they had inflation dropping already below 2% as of the second quarter of 2027. So with everything going on now, such a scenario has become more likely. And if we were there, and again talk about potential inflation undershooting, then I think we would have a clear case for at least correcting the rate hikes of this year.
Okay, we have another question about the Fed tonight, and is there a possibility that they could drop the easing bias? There has been a lot of political pressure, from Trump to keep rates low. What do you think?
Well, I think I'll just go with James Knightley here. So we expect the Fed to actually drop the easing bias, maybe even at a tightening bias. But this is currently clearly not an environment, despite political pressure to cut interest rates. But this is not an environment in which the Fed can stick or hold on to this easing bias. It's either balanced or with a tightening bias.
Okay, Chris, you've talked about the euro dollar by year end, and somebody wants to know sort of more near term, sort of by the end of the third quarter or in the third quarter, where do you see euro dollar sort of near term?
Yeah, I mean, we put out our sort of FX Talking, our monthly kind of publication late last week, or actually Monday, and we were looking for maybe about kind of 115 by the end of the third quarter. That was before kind of this sort of deal got struck right in the middle of it. So I think we want to see what happens with like the US data over the next sort of 4 to 6 weeks or so. And tonight's kind of Fed, I think, is going to be kind of really key. You know, if Wolf says something that sounds dovish, seems unlikely. I agree with kind of Carsten, the removal of the easing bias and some hawkish hints. But if somehow he tries to get some dovish message across, that would deliver a weaker dollar earlier. Personally, I think we're going to hang around these levels like 115, 116 for longer, and the dollar decline will be coming in a bit later. I think really you've got to wait close to November, December before you can really look for a sustained dollar bear trend, I think.
Okay, now away from this this subject, somebody wants to know about about euro sterling, given the political instability. Where do you see euro sterling at the end of 2026?
Yeah, I think we've got forecasts around kind of 88 for a couple of reasons. So it's got very good support down here at kind of 86. We've got the Bank of England tomorrow, James Smith. I think we're looking for a 7-2 vote for unchanged rates. And the Bank of England will try and ride out this inflation cycle without tightening at all. So clearly, if we do get another kind of ECB hike in the third quarter, kind of rate spreads are going to move in favour of the euro and against sterling. And I think into kind of next year as well, the view would be that the Bank of England will have opportunities to cut rates, to bring rates down to kind of neutral. So add in obviously some political uncertainty. Andy Burnham, you know, are we going to get sort of a coronation or a ugly leadership battle? I think that does deserve a little bit of a risk premium going into sterling. So I think 86 supports holds, and we do drift towards 88 by the end of the year.
All right, so we are just about out of time. So thank you very much for joining us today. Thank you to Carsten and Chris and Michiel. And we hope you found this useful. You can find more information about all of this, of course, on our website at think.ing.com. And do join us next time. Thanks.